Oh boy. Upstart Holdings down 56% in one day. So they released earnings last night after the bell, and today, you know, 56% that's just ridiculous. And once you look at where the stock was just a few months ago, it's even more ridiculous. So what's up, you guys? Zoe here from OneGlanceTrader.com, and in this video we'll be looking at Upstart Holdings and whether or not it is a buy today just after they've released earnings. So hope you like this. Make sure you like, subscribe, and if you've got a ticker or a company that you want me to have a look at and work out its intrinsic value, comment on it down below, and I will put up a video as quick as I can for that particular stock. So before we get into it, you can get up to 5 free stocks worth $3,500 each by signing up to the Moomoo brokerage. And again, it's absolutely free. So it's basically free money. So you just deposit $100, you can get up to 5 free stocks worth up to 3,500, and you can just sell the stocks if you really don't want them and just take the money. So again, why wouldn't you sign up? Again, the first link down below inside the description, so check that one out. So going back to Upstart here, and the funny thing is, right? If I even close down, they have smashed their EPS estimates numbers, since over the past year, and Q1 22 wasn't any different. It beat EPS by 15.26%, even beat revenue by 3.3%, and the stock was still down by 56%. So the reason why the stock was down to they have reduced their earnings guidance. And for those who don't know who Upstart is a leading AI lending platform that banks, institutions, and consumers can, connect up into to aggregate loans to find the best rate, all these kind of good things inside there. And, you know, it's not a stock that I personally own. I've been reading more about its kind of business model, high gross margins, low cost. Yeah, and the stock has been absolutely decimated. So I thought, why not do a video on it to have a look at to see what's been kind of going on inside this company. So if you guys are new to how I like to value stocks, I like to calculate the intrinsic value of a stock. So an intrinsic value is the worth of all its assets, its earnings, its cash flow, all that kind of good stuff, and what the company would be worth if we sold everything today. And there are many different models to kind of work this out. I'll be using the earnings valuation model. A lot of people like to use a discounted free cash flow, which is, some argue it's actually better than an earnings valuation. But I think this gives you a good ballpark to start seeing whereabouts is it, and then moving on to a bit more complex discounted cash flow models if you so choose to as well. So what we're trying to do as long-term traders, swing traders, or investors is trying to understand what the intrinsic value is and see where the current market price is in relation. Is it overpriced or underpriced? So if we go on to Upstart here, you can see here that, back in October 2021, this stock, reached a high of just over $402, and now it is down to, what's the low on this stock? The low on this is, around just above $28, and is down 92.9% since October 2021. That is absolutely insane. And that doesn't mean that it's a buy right now, right? We need to have a look at the fundamentals of the company. And again, we'll be using the earnings valuation to kind of do this. So the best way to kind of do this, in my opinion, to get a quick fair view or fair value view of Upstart is using my OGT intrinsic value indicator. And again, it's absolutely free. The link is down below to get it for TradingView. So once you go onto TradingView, if you go to indicators, type in OGT, and again, you'll see all the scripts that I have on here, and the intrinsic value indicator is here. And again, I've got a dedicated video which I'll link to down below as well. And the way it works is there are three kind of inputs to the indicator. The first one is we need to understand is what is the EPS or the earnings per share growth rate over the next 5 years. And the good thing at the moment, if you look at Upstart's current trailing 12 months EPS is $1.40. So it's actually a profitable company. And this valuation method only works on profitable company or our positive earnings. Otherwise it just won't. Otherwise it just won't work. And what I like to do, if you've seen my previous videos, is use analyst estimates over the next 5 years as my kind of high assumption. So this indicator gives you a low, medium, and high assumption. So you kind of got 3 levels to kind of play with. So the way I like to do that is looking at Yahoo Finance. And again, if you type in the ticker symbol, 56% is just barely up after hours. If you go to the analyst section and you scroll down to the bottom, it's got a section called growth estimates, and what you're looking for is the next 5 years. And you can see here Upstart's consensus estimates is 30%. So what we want to do is plug in 30% in the high, and obviously this hasn't taken into account the news of their kind of guidance for the next quarter. So what we've done here is, again, I've gone with, a medium assumption of 20 and a low assumption of 10% annual growth. Let's put that back to 10. The next bit is then what we want to do is it then multiplies those earnings over the next 5 years, and then in year 5 we need to set it a year 5 multiple of the multiple of what we want to potentially, buy the company for those earnings, and that's known as the PE ratio. So we have to know what the PE ratio is in year 5. So what I like to do is look at the historic PE ratio of a company. You can head over to Y Charts, completely free to look at up to 5 years worth of data. You can see here it doesn't have a lot of data, so we'll just look at the last 1 year. And you can see at the moment that it was at highs of when it was at the $300-400 range. It had a PE of 512. 500. It was trading 512 multiple of its earnings. Ridiculous. And it was way overvalued. And as you can see, it's been dropping now to its low at the moment of 23.85. And the higher the growth, the higher PE justification that there is. However, I like to be conservative with this stuff, so I've gone with a low estimate of 15, medium of 17, and a high of 19. And the last piece is once it multiplies the year 5 earnings by the PE ratio that you've selected, what we want to do is discount that year 5 share price by our annual rate of return of how much we want to make every single year, back to the present value of what we should be paying for the stock. And again, I like to put 12.5% for kind of 2 reasons. One, you can get about 8 to 10% on average for the S&P 500. So I want to put a bit more of a premium on top because I'm picking individual stocks where there's more risk than going into an index that has, hundreds of stocks. And secondly, these assumptions could be wrong, right? So I want to give myself a little bit of a margin of safety on here, just in case some of these estimates are kind of wrong. So what you do is when you hit OK, what happens, I'm going to make this a bit bigger so we can kind of see what is going on here. It then gives you a table to shows you all the calculations of your high, low, and medium assumption. And it's got the current trading 12-month earnings. And then what it does, it plots the next 5 years out in terms of what the intrinsic value is. So it's basically this red line over here. And again, this is just one model, and it really does depend on your assumptions. So if we have a look now, this is a weekly chart of Upstart. So this is that massive 50% down candle for the current week, and you can see now it hit a low of, where's that, 29.02, which is just under your medium assumption. So the medium assumption, to remind ourselves, was a 20% growth rate at 12.5% return at a PE of 17, right? And you can see here that the low assumption, if you only think Upstart's going to grow only 10% annualized over the next over the next 5 years, again with the PE of 13, I think it was, that's trading at around 19.19, so about $20, right? So what I personally like to do is I like to then start selling puts below the assumption that I'm interested in. So in this case, I'll be looking to sell puts on Upstart at around $19. So I'm just curious actually to see what the options chains look like for them. So if we go a month out, what's the date today? The 10th. So exactly a month out is June the 10th. We go to puts. It doesn't even have the $20 strike, does it? It doesn't even have it. Can I add more strikes on here? No, it doesn't even have it. That's how much this hasn't even updated. Surely it's got to have it. Surely if we go to the 20th. No, you've only got like the 36 strike. What's the current price of Upstart at the moment? 33. Doesn't even have it. That's how much it's dropped on here. So I can't even show you that. So yeah, so that's kind of how the model works. And again, any company that has a positive earnings for the last 12 months, and you'll notice that, you'll see this over here, then you'll be able to do this. At the moment, if you believe in the high assumption of analysts with the PE that I've set, it is undervalued. It is currently at the medium assumption. You know, I think, below $20, to go get 2 grand's worth of shares in this is, what's the low when it opened, when it IPO'd? The lowest it went when it IPO'd was 26, right? It's even below, it's not below it currently, but that's kind of where you want to look at. And the growth of the company since it's IPO'd is a lot better than where it was when it first started. So if you know how much the company has grown, this, in my view, is an overreaction to the market, right? We are in feared times at the moment. If we were in a bullish market of a company that beat top line, beat bottom line, it would have not tanked. Even if they did not very good guidance there, in a bullish market, it wouldn't have dropped by 50%. If anything, it probably would have been up, right? So again, try to take advantage of these markets. Again, the things I would do as part of the next steps is look at their free cash flow. Are they growing their free cash flow? Is it positive? And again, if it is negative, but you can see where the growth's coming in. This company has a high gross margin. I think it's in like the 80% because it's all algorithm based and all software based. These software companies tend to have high margins here and a low kind of cost base with employees and all those kind of different things. So definitely something to be looking at here. I might start getting interested below $20. I'll keep you updated if once I see the options chain. If the options chain is attractive, then I'll definitely might look into it. But something to consider. I hope you found this video useful. Download the OGT intrinsic value indicator. Don't forget to pick up your 5 free stocks from Moomoo, and I'll actually see you guys in the next video.